in a large context, the way we do locally. Also, as one of our co-panelists, Tarun, pointed it out, this is going to create a huge entry barrier in this space. And therefore, obviously, one has to watch out. But in this context, to have a $5.7 billion deal augurs well for sure. If you just look at the quarter, the March quarter that has ended, this has been, in terms of value, it's about 600 million. I think it's one of the lowest in terms of quarters, and we are expecting sharper declines, is what the investment analysis community is telling us. If you look at the M&A volumes, again, M&A, there have been 189 transactions this quarter. We track M&A a lot. Tomorrow, our March 2020 deal quarter, which is our quarterly deal tracker, will go out. In the last 6 years, consistently on a quarterly basis, the transactions are between 250 to 300. This quarter already we have got much lesser, even in terms of value. Sentiments definitely are weak in terms of taking bolder bets. So M&A definitely is getting impacted. We expect that there will be exits which will be challenged, due to valuations, due to sentiments. So again, there will be slower pace in the PE and the VC exits. Valuation multiples, obviously, we'll see a reality check. We have specific questions on valuation. We'll discuss those. One interesting update that we all heard yesterday was the government is looking at investing almost another $1.5 billion in equity of MSME, either through a direct fund or through a fund of fund, maybe administered by SEBI. We are waiting to hear the formal announcement. We are also hoping that the economic stimulus 2.0 is announced sooner rather than later. So given all of this context, and given some specific questions that we are hearing, let's move on to the first question to start off. And I call it a question set, because within a question, we have a few. So as early stage investors and as growth stage investors and even as advisors, because we have everybody in the room today, how do the panelists view the fundraising environment for startups? What advice would the panelists give to the founders, especially those who are running low on cash, few months of runway, and they're looking to raise funds? What would be your advice? Should they be looking at bridge rounds? Is there any other way to think, venture debt, etc.? And just from your own fund perspective and what you're seeing in the market, have investment decisions been put on hold, or are you actively now seeking more opportunities outside of your portfolio companies as well? So these are the first set of questions for all. So can I ask Beena to start off the panel?
Thank you, Vaibhav. Well, to start with, I would say that fundraising environment has undergone a sea change. It is not what we saw just a month ago. Definitely Jan 2020 was one of the peak season when we saw the PEs going up. We saw the market upbeat. But yes, there is a new situation, which does not mean end of the world. It only means that, yes, there is a pause. There is a review of the existing environment, and the new business models are going to be reevaluated based on the current market economics, the current situation. The one who have cash will get easy money, in the sense they would be able to get more money for their future growth. But those who have limited cash have to worry about how to conserve cash and keep themselves afloat for about a year. And to answer the last question about, do we really looking actively? Yes, we have a good dry powder available. And at this stage, we think this is an opportunity for us to look for the next growth that is coming up. And really, we find that this is the repeat of 2009 GFC situation, where PE definitely moved into providing the much needed capital that today the other bodies, I would say, like the banks and are finding it difficult to contribute.
Sure, Beena. Thank you so much. That's a good starting off. Can I turn over the dais to Tarun?
Yeah, sure. So, I think, these are discussions we are having with our portfolio companies, almost every day. And I'll just repeat what I am telling them. I think two things if you're an early stage startup, obviously. I think first thing that one would do as a founder is to actually determine, if I were to make a 2x2, which is what's the impact of COVID on my company and my business, and how much runway do I have, right? I think the ones which lie in the most vulnerable bucket, which is high impact on the business and low runway. I think those are the ones where we are spending the most amount of time to figure out what do they need to do to improve and increase their runway, right? And obviously the extent of cuts that one needs to make are significantly higher if you fall in that bucket, versus the other end of the spectrum, where there may be a short-term impact because of lockdown, but overall they actually see the business in a stronger place post-COVID, because either an online education company or an online media company, or grocery or whatever it may be, right? And they already have raised capital in the last 6 months, and hence they are well capitalized. So I think the discussions are very different depending on which spectrum and which quadrant you fall under. I think it's important that every founder determines for themselves where is it that they really lie, because of the actions that they take would be depending on that, right? So that's number one. I think the second is, just in terms of runway, my advice to every founder in our portfolio is make sure you have at least 24 months of runway in the worst case scenario. And when I say worst case, we are literally taking it as, between 3 to 4 months of zero revenue, another 3 to 4 months of maybe, 20, 30% of revenue uptick, another 3 to 4 months of 50 to 70% revenue uptick, and only after a year, getting back to 80 to 100% of where you were pre-COVID, right? In that scenario, because that also in some ways takes into account potentially a longer lockdown, potentially second sort of wave coming in, which again nobody knows. The reality is nobody knows today, right? But if you hopefully planned for the worst case scenario, you at least have the luxury of time to see as and when more data is available, that you can then start making adjustments as required, right? So that's the first thing. I think just making sure you are first there to survive and see through this is extremely important. The second is, I think, in terms of asking, once that is done and you stabilize the company, I think then the conversations very quickly shift to what is the relevance of your product offering in a post-COVID world, right? There are some businesses, like I said, that will become even stronger, but there are a large number of businesses where the relevance of that business in a post-COVID world will drastically reduce, right? And so one needs to start thinking about, okay, 3 months out, 6 months out, now that runway is not an issue, what do I need to do to pivot my product offering? What do I need to do to fine-tune my product offering, tweak my product offering such that I'm still relevant in a post-COVID world? And I think the last one is, honestly, a lot of founders, once they've done these two activities, are actually starting to, move from what we call defense to offense, where people are saying, okay, what, fine, what has happened. But like they say, never let a good crisis go waste. And so a lot of people are actually thinking, because see, the other reality is market share has been reset to zero across every segment. No matter how big the company was and how small you were, the reality is now everybody's at zero, right? And how do you use that to your advantage and say, hey, you know what, post-COVID, I can actually accelerate and gain market share because I'm doing things that other people may not have thought of, right? And so a lot of our discussions are actually also starting to move in that direction.
That's great, Tarun. We have specific questions on scale up and growth. I'm going to come back to you on this. Sure. I'm sure everybody would love to hear their defense to offense and how they should think, about growth and sure. with a zero-based budget. Let me go over to Rajesh Sehgal. Rajesh, did you want to give a take on this?
Yeah, sure. I think this is a topmost question on everybody's mind, whether you're a startup or a mature company or a fund like ours, or even governments, by the way. So, arranging for funds, making sure you have, enough cash for runway for the foreseeable future, at least. I think this has become priority number one for all of us. I can assure you that it's going to remain tough. In terms of a fundraising environment for all of us for the next few quarters, let alone next few weeks or months. So for startups and early stage companies that we are dealing with, on a regular basis, and also including our portfolio companies, those that have already raised capital have to ensure that whatever money they have, whatever cash they have, lasts them as long as they can stretch. before mess, I may make it sound to be there are enough and more funds out there with capital to be deployed. We all, as is the fund industry's structure, we all have money that needs to be deployed within a certain amount of time. So there is money out there, but that money is now going to be invested very, very carefully. The number of questions one has to answer has suddenly gone through the roof. Costs will remain the focus for every mature business, as I mentioned earlier. So in all, it's going to be a tough environment out there for the next few quarters, and we all need to make peace with that fact and manage our day-to-day affairs much more judiciously for now.
Sure, Rajesh. That's pretty good, pretty insightful, and pretty candid as well. So people, if those are in the middle, Rajesh. Okay, I can see the screen is frozen for him. Maybe we'll come back to him. So with this, let's move on to the next question, and we'll have Rajesh catch it up as we move. So the second one was, as we enter into a recessionary phase, maybe next 12, maybe it could be 6 months, 9 months, 12 months, 24 months, depending on which industry, whether it's hospitality, etc., will have a larger rounds. Um, just from a deal evaluation perspective and just the investing process while screening opportunities, assuming that you guys are still getting constant inquiries from new sets of founders, how are you looking at the deal evaluation? Would there be a higher emphasis on cash sustainability, profitability, as opposed to just growth with cash burns? What about unit economics? Is it now more relevant more than ever? Efficiencies, frugal existence, lower discretionary spends. So just some take on all of these. Tarun, can I ask you to start with this?
Yeah, sure. So I think some of this had already started, Vaibhav, even before sort of COVID hit us. I think, given the WeWork blowout and some of the other things that people saw, I think the growth at all costs mantra had already started seeing a shift in sentiment. There was already a lot more discussion around unit economics. There was a lot less, investors were a lot less forgiving on companies that were, constantly growing top line, but, the business model below was not sort of making sense. And if they were contribution negative, then most investors were just staying away from such companies, right? So that was number one. I think, at every stage, it's always investors will overnight, completely swing to the other end of the pendulum, because essentially you're still looking for breakout companies that, over a long, period of time can become large companies. So I don't think that, it's ever going to be one or the other. Maybe you will index a little bit more on positive unit economics and positive, profitability relative to a high growth company, right? In terms of how the investment process itself and the deal evaluation, see, right now the practical challenge is that everybody's sitting at home, all of us are on video. I think there are two challenges that one needs to get over. One is, are you ever going to be comfortable writing a check on video, right? You have never met the founders, you have never spent time with the team. I think it takes a lot to build that trust, firstly, to write the check, and then to do that without having any sort of in-person interactions. Obviously the bar goes higher, number one. So if you have not already been in touch with this particular investor, as a founder I'm speaking, if I have not already known them for a while, if I haven't met them in the past, it obviously the bar for them to get comfortable is going to be higher. Second is, I think for more mature companies where there is enough operations that are already existing, the other practical challenge is, how does one actually diligence a company where, people are not able to move around. So if I need to do supplier, visits, if I need to do on ground, customer feedback, if I need to do warehouse operations and, go and do all the diligence, I think we just have a practical difficulty today where we're unable to do it, right? Now, keep aside the, temporary loss in revenue, because I think that we all understand it's a one-time shock and hopefully, we'll recover. So my sense is right now, at least what we are doing, is we continue to invest. We have a lot of dry powder. We raised our last fund in towards the second half of 2018, and so we have a bunch of investments we can still make, and we continue to engage. We've actually announced already 3 or 4 investments in the last few weeks. Just last week we have signed 2 new term sheets, and so we continue to do that. The difference being we're looking at earlier stage companies which are potentially pre-revenue, and hence my check size risk is lower, and where I don't really need to do a lot of on-ground diligence because these are pre-revenue. So I'm really evaluating the entrepreneur and I'm evaluating the idea and the market opportunity. There's really not much else to do. The second is these are entrepreneurs that we have met in the past. We have tracked them. We have, we think highly of them. We have engaged in the past. And now that they are starting up, obviously the decision is easier. Now, that's not to say that we are not seeing investments happen otherwise. I'm just saying that the bar is higher, right? So we continue to engage with other companies and, over time, we will get over the line on some of them. But it is the bar for writing those checks is definitely gone higher.
Sure, Tarun. Perfect. That's useful to know. And you mentioned an interesting point that even early stage pre-rev companies, with a low risk, and that could also be kind of looking at today raising funds, and because the diligence time and effort will be a little lesser.
Correct.
It's still practical to do. And again, by the time we close any of this, it's still a few weeks. I mean, we should be back at least in offices and physical meetings. So that would be helpful. I have Rajesh Khairajani. Rajesh, the first one, as you saw, we were just looking at, the environment. So let me combine the environment question for you along with this question, basically the current phase. And when you are looking at valuations today for startups, if given that people are still looking at, opportunities to invest, just in terms of the deal evaluation and both the for whether it's any of these matrices, when you're looking at your valuation matrix, what would be your advice to the founders?
Right. I'm sorry, actually, I think I got disconnected. On the first round, just a quick take on, what I believe. So, as everybody knows, I'm a valuations guy. So I would say that it's more of an outsider's view. But in terms of, what the environment seems like for startup, in my opinion, I believe that seed will essentially be tough for all. So I believe that it's going to be tough for new entities, a way lot easier for the ones that are already funded, particularly those that are already Series A. And while I say that, I think that fundamentally strong business models would attract more money. Now, even with the ones who are writing the check would want to pursue opportunities that are relatively less uncertain. I think one of the questions that was there was that can we expect a rise in the bridge round, and I do believe that yes, bridge rounds would happen essentially for those with the cash flows mismatch. Those with have a serious disruption to revenue might probably be looking at their going concern assumptions being challenged. On whether the investment decisions have been put on hold, I would rather lean in what Beena, Tarun, and Rajesh's views were. And if I could, and while I have a caveat here that I'm not an investor, but I think that investors would definitely look for deals in primaries as well as in secondaries. So I think all in all, fundamentally good businesses might see value probably being not they were what they were expecting, but it's more of a timing issue, I would say. And for those who have the wherewithal, access to liquidity, their own or an open round of funding, probably might sail through this weather better than the others.
Sure, Rajesh. Thanks. Beena, can I turn over to you for the second question?
Right. I think Tarun covered it quite well about how the deal making process is going to change in the current environment. But I'll just add on to what he has been saying, that it is very difficult to make deal in the market where you're not able to see the promoters, not able to see the teams involved, and not able to see the business facilities, right? You want to see the facilities they have, the warehouses they have. You like to have all those boxes ticked before you really write a bigger check, because we do a growth where our checks are quite huge as well. So he was perfectly right to mention that, the way we do the deals is going to definitely have a little bit of moderation on the change of way you do the things. But yes, I think it will take a while for us to get comfortable till we really figure out how do we do evaluation of this. On the parameters that you mentioned, yes, the parameters will definitely be more intense. I think there will be required to give more discount to the trend line that you have seen in the past. And the other thing is, which are the businesses which will modify from here. So all of this will really be reevaluated. And I think uh, it will be another 12 months time before we really get a proper understanding of those businesses. But as Tarun put it, it will be possible to do deals in this market as well, because people have a finite time frame, people have a finite objectives of the businesses they do. And normally most businesses people would have had an past experience about. All we want to probably reevaluate is how these teams are doing and how these markets will these deals happen. But yes, there is money out, and there would be definitely deals with little bit more extra diligence on that.
Sure, Beena. That makes sense. Uh, can I ask the same question to Rajesh Sehgal? Rajesh, you're there? Yep.
Yeah, very much. Yeah. Can you hear me clearly?
Yes, Rajesh. Yeah, your video
Great.
was off, so we could not see.
Yeah, I think deal making and investing per se is going to, will change for most of us. The way we look at this scenario and the way we think it's going to be very different going forward is to imagine a train running at 100 kilometers an hour, right? And that's the economy. And India before demonetization was that economy, right? We're doing very well. And suddenly one fine day there was this whole demonetization shock that the economy got. So this train really came to a halt. But this was just a currency shock, the availability of currency for a very short period of time of maybe a month or two that everybody suffered. But then that got sorted out. This shock that we're talking about now, the COVID shock, is I think is much worse than even the global financial crisis of 2008. This is because this is not a financial crisis. This is, I think, an overall economic crisis. So in addition to the financial markets getting disrupted, it's business getting disrupted, it's personal lives getting disrupted, it's everything that's impacted. And 100 kilometer per hour train is just a complete sudden halt. So imagine the consequences of this, right? When you are, like Tarun said, and we heard earlier, when you evaluate a business to invest in, there's a lot of touch that goes into it. There's a lot of touch and feel. There's visiting the facilities, plants, manufacturing, people, assessing people, sitting across the table, having multiple conversations in person. Now try imagine doing that without a personal face-to-face interaction. It's not easy. I mean, look at this panel conversation we are having, right? We, thanks to technology, we can have this conversation, but it's not as rich in terms of its flavor as a physical panel discussion with four people sitting on one side of the table and everybody else in the audience, right? So man remains a social animal, and we are all trying to adjust to the new reality. And I think in the deal making space also, we will have to adjust to the new reality. What that new reality is going to be, how it is going to pan out, I'm afraid I have no crystal ball that I can gaze through and share. And I think nobody has a clue. I mean, even the presidents of countries and prime ministers of countries, we are all struggling. Scientists at the forefront of finding a vaccine or cure, etc. We are all in a new territory, in a new zone. So everything, including deal making, will be very, very different going forward.
No, absolutely. Now, you mentioned 100-kilometer train stopping to a grinding halt. I wonder what that means from a valuation perspective. All of you guys have invested, you have substantial investments, you have carries. So I wanted to turn on to, before we go to growth and people in M&A, I wanted to get into valuations. This is a question that we have been asked a lot in the last few weeks. A lot of concerned founders, a lot of their investment teams, some of our VC friends as well. So can I go on to Rajesh Khairajani for this one? Rajesh, if you look at you have been meeting founders regularly, advising them on how they should think about today the DCF forecast, the market multiples. So as this may give a distorted view today, how should this effects be incorporated within the valuation framework? And are you looking at down rounds? How does a founder think about valuations?
Sure. Vaibhav, on the screen, if I can answer the second question first, and then we can go back to the first one. I think most of the businesses who are looking to raise funds in this midst of the COVID-19 pandemic, and also those who are looking to raise fund before the dust completely settles down, and I say most of the businesses. So I do expect them to be down rounds. Now, businesses cannot be operating in silos, and this economic inactivity or this near standstill would most definitely hit valuations, in my opinion. So I will not be surprised for businesses that are raising funds would be more of a down round. Now, going back to the first question, we do a fair bit of work that involves valuation for M&As as well as financial reporting valuation. And as an outcome of that, we did share our views with the big fours, not just in India, but also with the North American and the European markets. And one thing or one question that was common in most of those discussions was that how are you incorporating the impact of this COVID-19 pandemic into your DCF models and market multiples? And I must admit that this discussion is still evolving. But I think that going back to the basics is the key here. When one looks at DCF models, what the promoters and for that matter even the investors need to ask themselves are these basic questions that has there been a disruption, and has this disruption really impacted my business? And I believe that for most of the businesses, the answer would be in the affirmative. The second and the more pertinent question is that how you as promoters or investors are incorporating the impact of this disruption in your business plan and consequently into your models. So I think going back to the drawing board and making an assessment on how soon would you go back to normal. How soon would you be going back to your operating at full capacity? Some may take a year, some may need more time, and some might probably bounce back in 6 months. Some just yesterday I was speaking with a client. They've seen their revenue drop to almost 10% of what it was, but while still they are incurring almost 70 to 75% of the cost. So I believe that it's going to be tough for some businesses. Whose going concern assumptions are impaired. I'm afraid they may shut shop never to reopen. Have seen that with a couple of friends operating in the restaurant businesses. I think on the market multiple, I believe that multiples would be far less attractive on an exit standpoint. But again, I think fundamentally strong businesses that have the power to ride the storm would not see much of value erosion if they are able to get through, through this difficult phase. Vaibhav.
Sure, Rajesh. So we have already started getting questions from the audience, but I would just hold them off. Somil has alerted me we already started a bunch of questions coming in. But let me turn over to Tarun on this one. Tarun, how are you guys looking at valuations today?
Yeah, so 2-3 points. I think one is if you have enough cash in the company, and you don't need to raise money immediately. My advice is to don't distract yourself. There's enough happening on the business front. Just postpone your fundraise. Create more runway for yourself, and postpone the fundraise so that you don't necessarily need to take a down round. Because if you go today in the market, the valuations are definitely not as attractive as they were even a month ago, right? But keeping that aside, the larger point is, and obviously a lot of founders will say, listen, I don't have the luxury to wait 2 years or 1.5 years or whatever it is to go in the market. I need the money today, or I need the money in 6 months, or whatever it may be. I think in those cases, my advice to founders is very simple. Listen, if I take all the public market comps in your domain, right, a lot of those public company stocks have created, 40%, 50%, 60%, some cases even 70%, right? I think it is irrational to expect that private valuations, which were anyway at a premium to public market comps, should not face the same fate, right? Now, remember again, your revenues have gone to zero, very close to zero. So eventually, if you are expecting to be, where you are today, 1 year from now, in a reasonable case scenario where things recover, the reality is your valuation is going to reflect that, right? At the end of the day, that's the math that investors are doing. And so my advice to founders is, one is obviously, if you can afford to postpone the fundraise, do postpone it. But most founders, unfortunately, are not in that scenario and need to raise money sometime in the next 12 months. If they need to do that, my advice is very simple. Take money at whatever best terms are available. There is always, there's this saying where you live to fight another day. And my thing is, live to make up your valuation or the additional dilution that you take for another day. Obviously, don't compromise on the quality of the investor. You still want an investor that believes in you long term, that is going to be around, that is going to share the same vision as you share, and they're not squeezing you unnecessarily, right? Because that's not the kind of investor you want on your cat cake. You want an investor who is getting a good deal, is willing to back you, is putting money when nobody else is willing to put money. So just take it. And there's a saying, right? Flat round is the new up round. So just take the money, and if it's at a flat round to your last round, and if it's a down round, so be it. It's better to live to fight another day and survive versus shutting down your company because you may be diluting a little bit more. In my mind, these things all even out over time.
Sure. So Tarun, you're saying survive to grow.
Yeah.
If you're there, you will grow. Makes sense. Can I ask the same one to Rajesh Sehgal? Rajesh, did you want to have a quick take for especially the early stage companies, some of them even pre-revenue, very, very early stage, not having a proven revenue model yet. And, we've had fancy valuations being, offered. So how should they think today about it?
Yeah, I think, we all know that valuation is part science and part art. At the startup phase of a company's life, valuation, in my opinion, has always been more art than science. Because all the science you can use for maybe more mature companies, even that is debatable. But at the early stage, it's more art. And therefore, there's a lot of subjectivity. Given the current, even forget this whole COVID episode that started, since the beginning of this year, even as we headed into 2020, there were a lot of concerns. There were a lot of, business implications. The economy was slowing down. We had 7-8 quarters of low prints of the economy number. Number of deals that were getting done, were falling not off the cliff, but slowly they were reducing. Round sizes were going up, etc. So we headed into this whole 2020 new year not in the best of shape. So valuation had anyway, if you look at data, returned down to same levels, normal levels, etc. But I think this whole COVID thing, nobody was prepared for it. It not only brings, like we discussed, it was linked to the first question of cash raising and fundraising. It's about demand and supply. So there is going to be very little supply of cash. Cash is going to be very hard to come by. It has very direct implications for valuations of companies, let alone fundraising itself. So even if a startup is able to raise money in this environment, forget about those esoteric and stratospheric valuations. It's going to be more earthbound. Not necessarily a bad thing for the environment or for the ecosystem. As long as I think the investor and the company, the founding team, etc., think it's a win-win, I think deals will happen. So my view is valuations will come under pressure in areas where there was a lot of, or even a little bit of, bubble. But in many other areas where valuations were really linked to what was happening on the ground, things will continue as they were. This is not a time, and we've been talking to a lot of startups. We've been talking to all our fraternity people as well, the investors. I don't think the mindset is now to make the most of the situation and really press down on valuations and get a better deal, because in the long run, and venture capital or early stage investing is a long-term investment asset class. In the long run, if both partners don't feel that win-win coming through, it won't end well. So yes, there will be some pressure on valuations, but I think only in areas where we had some kind of froth.
Sure, Rajesh. Rajesh, if I could just make a quick request, it's come from one of the audience. If you can just turn your camera orientation, we are seeing it a little upsided. That's for Rajesh Sehgal.
Oh,
Uh, okay, moving
I don't
on.
know.
Yeah,
I can't
this
see
is fine.
myself,
This
so
is fine.
this is
Yeah,
okay.
Beena, yes, this
Yeah,
is perfect. Beena, I'm going to turn over to
great.
you for the next question, and this is really a very relevant one from a growth and people perspective. Just if you, looking at your portfolio companies in ICICI Ventures, what are some of the measures that you have been seeing and you've been advising your clients, your investing companies for from a scale up perspective? Also, just for founders, how should they think on people keeping their teams motivated? What has been your advice to them?
Yes, Vaibhav. So there are a couple of different strategies for different companies depending on what kind of labors or kind of people that you are dealing with. If you are dealing with companies which are, I would say, in situations where you can rationalize and do have some bank balances, it's easy to discuss. You can give them ESOPs, you can give them a confirmation that we would have this percentage of reduction in salaries for some of them, or for senior people have higher cut, for junior people no cut on their salaries, depending on what situation you have labor. But if you have migrating labors, or do you have any kind of people who are living on daily wages, for example, in some of our real estate portfolio, you have construction where you have people who are waiting for your daily labors. There's nothing to discuss. In fact, you have to spend more and ensure that they don't go back to their towns and then don't return tomorrow. So there, I think what our developers are doing is they're trying to ensure that these people are taken care of in this time. They're being provided food and shelter and necessary support to ensure that they do not feel that they are feeling difficult to stay in this particular environment because they see the highest pressure. So those people finding difficulty is very different from the difficulty you find in portfolio companies, let's say like Theobroma, or you can see in companies where you have different kinds of people where you can negotiate, or you can rationalize, or you can see value in ESOP. You can always tell them that we can make up in ESOPs. So people management is all about how you make them feel that they are part of the business and they will be rewarded at the right time, and they are to contribute towards the survival of the business to its current situation. With respect to the other operations, yeah, I think the current challenge that all of us are looking at is how do we bring back the businesses back to its normal capacity that it was earlier running at. I think in the past, when we had the shutdown, I think everybody went to zero capacity, right? So there were different challenges. One was the challenges of people. Second thing is the challenges of getting the supply chain back. So you need to ensure that that particular angle also is addressed. You also have to look at your cash. You have to look at all your other parameters. So it's going to be um, uh, dependent on the business specific, and you need to probably focus on each of this depending on which business you are learning, business that you are dealing with. But yes, I think people management is going to be the biggest skill, and it is going to be definitely important, because if they feel that they have been taken care of in this difficult times, they will be there forever with you, or they may leave you. So this is a very important phenomenon where you need to negotiate and get them on board with you.
Sure, Beena, that's pretty useful. Uh, could I request Tarun to give a perspective here, both on the growth, the scale up, and people?
Yeah, so I think I'll talk a little bit about scale up challenges. Like I said, I think the discussions in the early part were much more focused on survival and much more focused on relevance of the business itself in the post-COVID world. We have just started discussing scale up with our companies to figure out sort of what they can do from a defense to an offense, like I mentioned earlier, right?
Right.
I think one of the items I mentioned, and like I said, it's very hard to see a silver lining when everything around you is so gloomy. But founders, one of our founders said this statement, and I thought it was extremely insightful, which is, what, this is the best time. Market share for all the competitors in my space has gone to zero, and I actually have an opportunity now to scale up and build a much larger company from here on. And so, we are literally, like I said, we're talking about, obviously, some of those things I can't share openly, but we are talking about in specific companies, potentially new product offerings. We are talking about tweaking our existing product offering. We are talking about how we can potentially acquire smaller companies in that same segment that may be unable to raise capital and hence will be available for much cheaper cost than they would have been otherwise. Because again, fundraising is going to get harder. And so if you are in that fortunate position where you have got enough of an equity value, you have a strong balance sheet, you should be able to acquire smaller companies in your segment to be able to actually take advantage of that, right? So we're starting to have many of those conversations. And by the way, I believe that the amount of consolidation that we'll see in the next 12 months is going to be far higher than what India has ever seen. Because people, like I said, investors are going to get much more picky. There will be some founders who will want to stay the course. There will be a lot of founders who will just say, what is better for me to align with a stronger balance sheet company versus sort of going it alone myself, right? Because the chances of success will be that much higher. Sorry, I think there was yeah, and then I think the last one, which has been in terms of people strategy and keeping the team motivated. People have been doing just the way we are doing Zoom calls and webinars right now. All of our portfolio companies very quickly move towards the whole work from home thing. And Vaibhav, you were saying before we started the webinar that it's amazing. Sometimes you feel, why was I spending so much time and energy in commuting? I could very well have done all my work from home. And some of us are privileged in that sense that we have a good work from home setup. We are in lines where whether we are at home, whether we are in the office, the work doesn't really require us to be on the field. We can pretty much get by doing everything remotely. So a lot of founders spend time in getting their work from home infrastructure in place for their teams. Second is I hear of people doing all just a casual Friday evening chat, keeping a down hall on webinar like this with the whole team, keeping the team motivated. We are doing this, by the way, at Matrix every week or every 2 weeks. We are getting the entire firm together and just completely no agenda. There's almost like a sidebar coffee chat that you would have in the office. We are just enabling these things because end of the day, and as human beings, you all want to connect with somebody, right? You want to see your colleagues. You want to have that sort of casual chat that you don't get to have now because over the Zoom calls it's all very formal and very sort of time bound, and it's exhausting, right? Like none of us are used to sitting in front of a screen 10, 12, 14 hours a day at a stretch. And so at least I don't know about you all, but I'm finding the work much more intense than it used to be pre-COVID, right? Because also you're having more difficult discussions as you're doing it. And I think the last one is, I think in terms of people cost, I think most things that we have told founders, my advice to founders is that, listen, people are your biggest asset. In these times, it is even more important to keep a long-term view and not let go of people to the extent that you can afford it and you can help it. But look at creative ways in which you can, potentially restructure compensation packages, because even people understand what is happening today is a once in a lifetime event that we all are, living through together. And so we have been surprised in our companies, people have gone and converted a larger part of the compensation from fixed to variable. Some people have taken voluntary pay cuts. Some people have said, what, take my, salary, cut it by half, but can you give me that half in terms of ESOPs, right? So they are actually showing even more belief in these companies at potentially a very, very vulnerable time that most companies are going through. So we have been very, very surprised to see just how well employees come together and supporting companies in these times. And so my solution to most founders has been, listen, letting go people should be the last option. You should actually try to see if there are other ways in which you can bring your cost structure down. And you will be surprised when you actually honestly share this with your team, how supportive they are.
Sure, Tarun. No, that's pretty useful. I think most of our clients as well, we are seeing a similar refrain. Nobody even wants to cut down the pay as far as possible. Try and figure out other ways. And you mentioned consolidation, and that brings me to the last question for the panel today, and then we'll go into the Q&A round. We have a lot of floor questions. So can I ask Rajesh Sehgal to kind of give some thoughts on M&A? So Rajesh, two specific questions that we are seeing.
Yeah.
Do you see a case for more consolidation today? Given where we are headed, both startups, even corporates, people will keep looking for aggregating market shares, for bringing. You may have in your portfolio a couple of companies, similar space. You want them to combine. Do you see more of that happening? Investors coming together, and just from a buy side as well. How are you advising founders? From an M&A perspective, should they be looking out for inorganic growth and start planning for those because there are opportunities?
Yeah, I think this is going to happen whether we like it or not. There will be a very strong wave of consolidation in times to come. It's all Darwinism, right? The fittest will survive, and people who can really adapt to the current situation will survive. So you will see a lot of weak hands, a lot of weak businesses, whether on the business model side, or the weakness comes from the balance sheet or the cash flow situation, etc. Can be a variety of reasons, but there will be many businesses that will die in this environment in times to come. Most of them will reach out and try to see if they can find a new home. For stronger companies, backed by capital or inherently strong businesses, it will be a great opportunity for acqui-hire to get certain pieces of technology puzzles that they didn't have at a very good bargain price. So I mean, to cut a long story short, yes, I think consolidation wave is about to unfold. It will.
That's great. I think that's also a good from an exit point of view. There will be structures where there could be partial exits, so people are not stuck for, especially funds which have seen the end of the runway. And at some point, even the primary market, maybe 12 months, 24 months, you'll see the secondary market. There are already pipe deals people are talking about, so that should kind of rebound.
Oh, very much. This will happen not only in startups in early stage. This will happen in small, mid cap, large cap companies as well. You will see consolidation at a much different level.
Sure. So can I now turn over to the floor? We have 30 questions already that have come on my WhatsApp. I just asked my team to keep sending. Let me pick up three or four ones that are coming over. Then we can see how much time we have. So the first one was a sector specific question, and I'll push it to Tarun. Startups dealing in fruits and vegetables and frozen segments, frozen foods. There's an anti-China sentiment that people are seeing clearly. The world is looking for alternatives. Is this a good opportunity for funds which are looking at this thesis, both in terms of valuation and funding?
Yeah, so I think I saw that on the Q&A window. See, my broad I have two things. One is the grocery segment in India is massive. It's the largest spend of sort of consumer GDP. Very, very small part of that is organized today. Within that small part that is organized, an even smaller part is online, right? So that opportunity for somebody to build out a grocery tech company online is there, and whatever the current incumbents have achieved is a very small part of the overall opportunity out there, right? That said, I think the current trend of everybody jumping into fresh fruits and vegetables and everybody doing grocery, I don't think people realize how hard it is to build a grocery company, right? It's a low margin business. It requires very, very large volumes before you can see any sort of material revenue starting to flow in. It is highly operationally intense. It is not, and with that you add the whole issue of sort of fruits and vegetables going bad, and if you don't have the right technology and processes and systems to take care of that, I mean, you could be looking at severe losses in your business, right? And so I don't think people should jump into these business ideas just because they are the flavor of the season. These are not easy businesses to build, and have taken, even the companies that have been out there have spent several years and hundreds of millions of dollars, and even today I don't think it's clear that those companies have come very close to solving the real problem, right? Now coming to the anti-China sentiment, see, I would say again, these things are very, very hard to know exactly how long this lasts. Is this a knee-jerk reaction and will it go away in the next 3 to 6 months, or is it something that will, a year, is here to stay for a while? In my mind, all investors on this call, everybody takes a very long-term view towards their investments, right? People don't say, okay, chalo, great, let me fund a grocery tech startup because, grocery is hot right now and there is anti-China sentiment. Let me do that. None of us think that way, honestly.
Oh, absolutely. So again, a lot of questions coming in and pouring in privately as well. There's a question from Jimmy Spencer. What happens to the replacement cost theory for capital intensive industries, where setting up a greenfield unit would cost multifold the current valuations? Beena, did you want to take that?
Okay, so I think it is to do with the industry, it is to do with various other parameters. Normally, when you take a business scenario, it depends on everything before we take a call on a particular industry. I think just because an industry is capital intensive, PEs don't think it is not a good business idea. It is all about growth and various other parameters about how the business is going to grow. That's the important part. So I think all businesses would really take off as long as they have all the other parameters of saying the growth, the other sector requirement as well. So I think it will be very difficult to comment just on the current question that is being raised.
Of course. Rajesh, from a valuation point of view, Rajesh Khairajani, there's a question on DCF. Do you see higher risk premiums? You see higher risk premiums being the order of the day?
So, Vaibhav, and I think we did internally discuss this, and I would say that the risk or the uncertainty in this case needs to either be factored on the cash flows or on the DCF. Generally speaking, we as appraisers would love to see, couple of sensitivity analysis and, most of the scenarios being modeled into the cash flows. But then I would not be surprised if, as appraisers going forward, we kind of add in an event-specific alpha into the discount rate. But yes, I mean, if you ask me, we would like to see it modeled into the cash flows as opposed to on the discount rate.
Okay. There's a question on the ready-made garment sector, domestic and exports from Amit Narke. What outlook do you see for the ready-made garment sector, both domestic and export? If any of you in your portfolio companies have a consumer around this, Rajesh Sehgal or Tarun, either of you, did you want to take that?
Well, we don't have any portfolio company in that sector, but I have some family in that business.
Sure.
I can tell you it's tough, because for them, the way they look at this business is this year is gone. And it's not about just the manufacturers, right? It's the whole supply chain, the distributors and the retailers, etc. So whatever they had, pushed out into the supply chain, for this season, the Ramadan and all these festivals now is all gone, right? So most of them, as soon as the situation opens up, it's all going to come back. The retailer wouldn't have sold it, obviously give it back to the wholesaler, and therefore the ability of manufacturer to push this down the supply chain is very limited. And immediately after this you have monsoon. So this year, more or less, I think if the current situation sorts itself out pre-Diwali, etc., then they will have some respite. Otherwise, this is a complete write-off. And also remember, for countries like India, Bangladesh, Vietnam, etc., the textile sector is still not as mechanized as China or the Western world. So you have a lot of people employed. So there's a lot of people who are getting their pay without any output this year. So this is going to be a very tough year for that sector. But going forward, it's part of that roti kapda makan. So this business won't go away. But this year is going to be specifically very difficult. I don't know if Tarun wants to add something to that.
No, nothing to add. I think I'm not too. We haven't spent too much time on that space, so don't really know.
But Tarun, I have a question for you. Also for the audience, for the participants, I know we have completed our time slot. We'll just take last two questions, maybe 2 or 3 minutes more, and then we'll wind off. So Tarun, the question for you is more from a stage of fundraising point of view. So you had mentioned about that, you think later fundraising could be challenging. rather than, why not take it and bend pen it and then kind of use it with the correct line of safety? So did you have a take on, from a right timing perspective, raising funds right now versus raising later if you have funds in the bank?
Well, see, if you can afford to wait, I would wait, right? Like I said, if you have a strong balance sheet, I think going into a market where, the world is going through one of its biggest crises, where valuations are going to be tight, where investors are going to take very, very long to get comfortable and make investment decisions, I think it's going to be a big distraction. And even if you were to come out on the other side where you get the capital, it's unlikely to come at terms and valuations that you like. So if you can afford to wait, I would wait. But if you cannot afford to wait, like I said, and see, let's all recognize, right? We are coming into this after the longest bull run that, we have seen. So I was just talking to another investor the other day. The reality is that till, end of 2019, the amount of capital that startups and founders have raised has never been higher. The valuations have never been higher. The check sizes have never been higher. A Series A round, which used to be, 3 to 4 million, became 6 to 10 million. A Series B round, which was 6 to 8 billion, became 15 million to 100 million. And so the reality is that most people's portfolio companies have raised a lot of capital in 2019. Right now, if you're the unfortunate few that did not end up raising, then you may not have a choice, and you should still go to the market and, like I said, get money at whatever terms that are available. But let me ask you this question, right? If you are a large company whose revenues have gone close to zero today, given the pandemic, and you're likely that it'll take you a year to recover and go back to your revenue that used to be pre-COVID, and you had $100 million in the bank, $500 million in the bank, what would you do? Would you distract yourself with fundraising, or would you, focus on sort of making sure that you come out strong out of this and actually go to the market to raise capital when things are back to normal, investors are back to valuing companies where they were earlier, and the amount of time that it took you to close a round of financing was lower? So in my mind, like I said, I think it all depends on, where you are, but if you can afford to wait, I would wait.
Sure. Okay, we'll take the last question, and I'll put it over to Rajesh Sehgal. In this COVID environment, what kind of opportunities or investments one can expect in all segments? So it's a fairly generic question, but just from a growth point of view or opportunities point of view, anything that you would be bullish about that you would look at from your fund perspective?
Oh, as they say, one man's sugar is another man's poison. So as we spoke about, a lot of companies, dying out or getting impacted, I believe there'll be enough and more, not just sectors, but also companies within all kinds of sectors that will continue to do well. And in fact, some of those will really make the most of this opportunity and show unbelievable growth that they even thought wasn't possible pre-COVID. So at Equanimity, we are sector agnostic. We continue looking across. I think our hypothesis has only become more, it's strengthened further because technology. So our hypothesis, by the way, is technology-enabled companies which are very capital efficient. So we've been doing that for the last 3 years, and I think today's environment, that is what everybody needs. You have to become extremely capital efficient, regardless of which sector you are in. And you have to ensure that you're using technology to the best in whatever business you are in. And I think for us, the opportunity set remains the same. We are not changing what we were doing. In fact, my recommendation to even other, co-investors, etc., has been not to change what you're doing, because we have our investors whom we are answerable to, and that set of folks, they don't like drift. They don't like you doing different things when external environment changes. So style drift is a real concern for all funds. So essentially, we'll continue to do more of what we were doing. We are, as I said, most of us, not just Equanimity, many other funds, we are sitting on dry powder. This is an excellent time to support the right set of people, the right sort of business models. In my experience, I've been investing for the last 25 years. Some of the best investments I've made, and I think my colleagues have made, have been during troubled times. This is where really you get the real opportunities, which 10 years out, pay you very handsome dividends.
Sure, Rajesh. Thank you so much. With that, friends, we'll have to end the Q&A now. We have most of the questions that have come. We'll try and address them separately, either by email or otherwise. We'll try and even go back to some of the panelists and get their questions. But in the interest of time, but I know some of the co-panelists have other meetings to attend. Let me thank each one of them, Tarun, Rajesh, Beena, and Rajesh Khairajani. Thank you for taking out time. You guys have been awesome. Some great candid insights. I'm sure the audience would have been enriched with these thoughts. We will count on you for some future webinars as we make progress here. Hopefully in more, in easier times. But thanks all of you. Also, I would thank my backend team, Kalyani, Saumil, entire markets team for putting this together at a short notice. Really lot of efforts to bring everybody. We had at the peak, I'm told, 165 participants out of the 280 odd who registered. So I think it's been a good session. So thank you, everyone. We'll be in touch with future webinars. Really appreciate your time today. Thank you.
Thank you.
Thank you, everyone.
Thanks, everybody.
Thank you.
Thanks for having us. Bye.
Bye-bye.